Hello, accounting superstars. This is Professor Don Bush. So glad you're here. I've been teaching accounting for about 30 years, been a CPA for about that long. I've got great ways to explain accounting, so if you want to learn about accounting, you're in the right place. This lesson is for people that are just beginning accounting, probably their very first class in accounting, and probably about week number 3 or 4. So this will help you out. We're studying depreciation. This is the fourth example on depreciation. Now, this example is no different than the other examples. So you might say, well, why are you doing another example? Well, the reason is I just wanted to show people a little bit about real estate. Real estate is a wonderful, wonderful investment. So, and I'll just show you one aspect of it. So here we go. So we've got Lisa's real estate company. And Lisa, what she does is she buys homes and she rents them out to families. And this particular house, this beautiful house, she purchased for just $200,000. I don't know how realistic that is, but it's a beautiful house, and Lisa got it for $200,000. Now, the market value is going up and up and up and up, and that's a beautiful thing about real estate. It usually always goes up. Before 2008, people thought it went up always, and we learned in 2008 that sometimes real estate can go down in value. But anyways, it's usually a very safe asset to own. So now what we're going to do is we're going to learn a little bit about tax law. And with tax law, it's different than accounting rules. And according to the tax laws, and you can blame Congress on this, that they decided to depreciate rental real estate over 27 and a half years. Now, why 27 and a half years? I don't really know. It has stayed at 27 and a half years for ages now. I remember when it was a little bit less than that, but then Congress changed the tax laws and extended it out just a little bit. So anyways, 27 and a half years. Now, why not 27 or 28 or a nice even number like 30? But they chose 27 and a half. That's just the tax laws. And so what one would do is one would take the original cost and divide it by the number of years. So the number of years is 27 and a half. So 200,000 divided by 27 and a half years. So you guys are probably already got that worked out in your head already, but I had to use Excel here to figure out what it is. And what the depreciation is per year is $7,273. It's just 200,000 divided by 27 and a half. Now, each and every year, Lisa will be able to take this depreciation deduction. In the second year, she'll get the same deduction. In the third year, she'll get the same deduction. Now, folks, I know that there are special rules like, half-year convention and all that. I know the tax law is a little bit more complex than what I'm explaining here, but I'm trying to give you the basic general idea, okay? So in the first year, her tax deduction for writing it off on her taxes, a huge deduction, $7,273. Unbelievable. Now, another thing that's really unbelievable is that the market value is going up. And in the second year, it's going up even more. And she gets to take this giant tax deduction. I mean, how many assets can you think of that work like this, that go up in value, and you get to take these monstrous tax deductions? Real estate is in a class by itself. So I'm just trying to help you guys a little bit, because I hope someday that maybe you will invest in real estate and own some rental homes. Coming down here, now the journal entry is the same thing as before. So for Lisa's business here, her rental business, she would debit depreciation expense like we always do, for the amount $7,273, and she would credit accumulated depreciation for the same amount. So from here on out, it's the exact same thing. Oh, and by the way, when we're doing taxes, we don't have to worry about salvage value. And you think about it, salvage value wouldn't make much sense because I bet at the end of 27 and a half years that this house will be really pretty valuable if it keeps going up in value like it is. Now, Lisa does not have to keep the house for 27 and a half years, but she would depreciate it at $7,273 each year for as long as she owned the home, up until 27 and a half years. So coming down to the income statement is no different, folks. And in this, by now in your accounting education, you should know two things go on the income statement: revenues and expenses, nothing else. So this depreciation expense would show up right down here. There it is. And then on the balance sheet, same thing as before. Same thing as before. Here we go. In the asset section, Lisa would record a rental property for $200,000. You might say, where are you getting $200,000? Well, that was the original cost minus the accumulated depreciation. Now, this is the end of the first year, so she would have $7,273 depreciation. Now, instead of book value, I'm just calling this tax basis, just so you can be aware that there's a little different language for taxes. But you know what? It's the same idea. You know, in all the other examples, we were using book value. Well, in this case, we're calling it tax basis. I'm just trying to teach you a little bit about taxes. So tax basis, $192,727. So according to the IRS, this house is worth $192,727, but look at this. In 2001, it went up in value. Wow, that is fantastic. An asset that goes up in value and you get a giant, monstrous tax deduction. I mean, it doesn't get any better than that. Well, the same thing for 2002. The depreciation is going to be $7,273. Same old journal entry: debit depreciation expense, credit accumulated depreciation. And expenses go on the income statement. Your balance sheet's going to look like this, except this time here, it's going to be 273 times 2. There we go. So there's going to be the accumulated depreciation for the second year. All I did was add up the 2 years here, 7,273, times 2, basically. And according to the tax rules, according to the IRS, this house is worth $185,454 right down here. But look at this, it went up in value. Wow, what a great thing. So I hope that taught you a little bit about taxes. And hope you'll look into this more. There are a lot of YouTube videos on how to invest in real estate, folks. It is a really wonderful investment vehicle. So if this video helped you out, let me know. Hit that like button, hit the subscribe button. That way other people can see these videos too. And good luck in your accounting class, and catch you next time. Over and out.